Yeah, welcome everyone to the Tradimo live webinar. Thank you for coming. And before we get going, I would like to check if everybody can hear me okay and see my screen. So if you could just confirm it in the chat box, that would be great. Looks blurred. I think it's maybe just a few seconds and it's going to clear up the resolution, but I'm not going to be the one presenting. So if there is an issue with my connection, that's not a major issue, as long as James's is okay. So today we have a special guest, James Harte, trader and analyst from LittleFish FX, and he will introduce you to the power of trend lines and channels. And you will learn how to incorporate these technical tools into your trading, how you can use them to identify high probability trades, as well as to keep you out of low probability ones. LittleFish FX is a trading education company, and their goal is to democratize the financial markets and make it accessible to everyone. And they do so by providing daily analysis, proprietary indicators, trade alerts, trading courses, and a lot more. Two of LittleFish FX's courses are available on Tradimo. One of them is the trading the NFP, and the other one is the top Forex strategies, trend line, Fibonacci price action, and more. I will pop a link into the chat box soon, so you can check it out yourself. And the two courses delve into more detail about some of the concepts covered by this webinar. And if you'd like to learn more how they trade at LittleFish FX, I encourage you to go over to learn.tradimo.com and check out these courses, or just click the links I'll share with you in the chat box. And as for the current session's topic, it is trading with trend lines and channels. And now, without further ado, I would like to welcome our guest speaker and professional trader, James Harte, to the Tradimo webinar. Over to you, James.
Great, thanks a lot, Peter, and thank you for that introduction, and thanks to Tradimo for having me here for today's session. I'm very pleased to be a part of this. Thanks to everyone for tuning in. Before we get going, I'll just quickly check that you can see the PowerPoint slides in the presentation window. You could just type in the chat function, that would be great. Yeah, brilliant. Okay, so as Peter said, in this first session, we're going to be taking a look at trend lines and channels. So this is the first in a series of education webinars that we're going to be running with Tradimo, looking at various elements of technical analysis, such as the ones that are featured in our top 4 Forex strategies course. So in this first session, we're going to be looking at trend lines and channels, okay? A classic method of technical analysis and a really fantastic way to help us frame the markets and understand price, understand the direction, and help us to identify trading opportunities. So in this session, we're going to talk about how to properly identify trend lines and channels and the different ways that you can use them in your trading and analysis. We'll look at some basic methods. We'll also look at some advanced methods and how you can combine trend lines with some of the other areas of technical analysis that we'll actually come to look at in future sessions. So kicking things off, first of all then, what are trend lines? For those of you who are familiar with trading and analysis, you'll know that trend lines very simply connect price points on a chart to give us an indication of how price is moving and to help us identify if price is following any clear directional bias. So if we can connect price points along an upward sloping gradient, we have a bullish trend line, and if we can connect price points along a downward sloping gradient, we have a bearish trend line. Now obviously, if we can't connect any price points along a clear slope, then the high likelihood is that we have no trend and we're in a range-bound environment. So if you have any questions during the presentation, please just write them in the chat function and I'll stop periodically to answer them. So here we have an example of a clear bearish trend line. You can see that we've connected our outermost price points. So in this bearish instance, we're connecting falling swing highs. Okay, so we're collecting a series of lower swing highs to give us our bearish trend line. Now, it's very important. You'll note that I've run the trend line along the very outer edge of price. So at no point does the trend line dissect price action or cut through any of the price action. The trend line runs along the very outer edge of price. And this is very important when you're just beginning to apply trend line analysis and you're looking to include it in your trading. You need to make sure that you're using what we refer to as absolute trend lines or classic trend lines. And these are where price action is always contained by the trend line. So the trend line doesn't dissect price action at any point. So the inverse then of the bearish trend line, here we have a nice clear example of a bullish trend line. And you can see that instead of connecting falling swing highs rather, this time we're connecting rising swing lows. So in this period of price action, you can see that we have a period of rising swing lows, and we've been able to connect them by these 2 points here, again, making sure that our trend line runs along the very outer edge of price action. So here we have a nice, clear, bullish trend line. And we've touched on there just briefly a couple of really key rules when it comes to identifying trend lines, okay? So firstly, we need to make sure that our trend line runs along the very outer perimeter of price action. So we need to make sure that it's never dissecting price action at all. Now, obviously, this just applies to the foundation level of trend line analysis, okay? When we're starting out, we need to make sure that we're using the correct lines. And the problem that I see with a lot of new traders is that when they're starting out, they're following the charts of more advanced and more experienced traders. They're trying to replicate those charts by using advanced trend line analysis. And the issue is that until you have a really solid understanding of the basics of trend line analysis, it can be very easy to confuse yourself. And obviously, if you're confusing yourself in trading, that can end up costing you money. So to begin with, you need to make sure that you're relying on the foundations and building a solid base. So always make sure that your trend lines are running along the very outer edge of price action. And then on any chart you're looking at, you're dealing with the absolute trend lines. Now, another point that is key to point out at this stage is that I only look to identify 2 touches of a line to give me a trend line. So whenever I'm applying a trend line to a market, I only look to connect 2 price points to give myself a trend line. Okay, so some people say that you need to wait until you have 3 touches of a line to confirm the line. And from my experience, I found that isn't the case, and I'm perfectly happy to look to trade a trend line based on the 3rd touch, obviously provided that the trend line is in confluence with other technical factors, okay? So this is really the key to these sessions that we're going to be running. We're going to be looking at these different technical elements on an individual basis. But then when we start to think about how we build trading ideas, it's always focused around identifying confluence in the market. And so identifying these different technical elements where they're in sync with each other. So making sure the trend line runs along the outer edge of price action, making sure it doesn't dissect price action at any point, and initially starting off with just connecting 2 points to give us our trend line. So coming on to how we actually identify the trend lines in practice then. One very key thing to point out is how we go about updating our trend lines. So you can see in this period of price action that our absolute trend line is drawn by connecting the initial low with this outer low, okay? So once we have this trend line in place, we've captured the very most outer swings in price. So all of the price action is contained above this line. So this gives us our absolute bullish trend line. However, you can see that if we had drawn this line initially, connecting it to this point, okay? So imagine that we were at this point in time where price had just made this second low and was trading higher. We would initially have drawn our trend line here, connecting these 2 points. And at that earlier period in time, that trend line would in fact have been correct, okay? It would have been correct up until the point that price broke through the trend line and forced us to update it. So if we go ahead and draw in our earlier trend line, which you can see from the most recent period of price action is classed as wrong because it dissects price action, you can see that earlier on, in fact, it would have been correct. So our trend line would have been correct and would have been valid up until this point here, okay? At the point that price broke down through that trend line, we then needed to update our trend line once again to consider this new period of price action. So we go ahead and add in our new trend line, which now connects this low to this low, okay? So imagining we're at this point in time here where price has just bounced, we're then monitoring the trend line, looking to see if price respects it, and we can see what happens here is that price trades back down, and then once again, we actually pierce the trend line, and so we need to go ahead and add in a new trend line, and that gives us our ultimate trend line, our absolute trend line rather. So this was the trend line we started with in our first example, and now you can see how we actually got there, okay? So at earlier periods of time, we would have been connecting the initial low to each subsequent low as it broke through the trend line. So this is the process that we need to be following all of the time, okay? And this is the process that I follow myself in the markets and that I advise a lot of other new traders to follow, is that you need to constantly be monitoring the charts and updating your trend lines as we go ahead. This ensures that you're always dealing with the absolute trend lines in a series and that price action is always contained by the trend line. Now, as you get more confident with your trend lines, okay, and you start to move into a little bit more advanced trend line analysis, then a really interesting aspect that you can add to your chart study is where you start to leave old trend lines in, okay? So we looked here how initially we would have had trend lines connected to this low and connected to this low, okay? But at each point that price breaks through, we erase our old trend line and we add in our new trend line, okay? But what would happen if we left those old trend lines in place? So this is what you can start to do once you move into slightly more advanced trend line analysis. So then you can start to leave your old trend lines in place. And here's a great example of the sort of opportunities this can afford you. So this is a daily chart of the dollar Swiss over the last 2 years. Now, if we go ahead and look at this low as being the very low, and I'll talk you through what each of these lines represents. So you can see that our first bullish trend line would have been connected from this low to this low here, okay? So you can see price bounced here, and then bounced here again, but then at this point, we broke down through that initial bullish trend line to make a new low. So we leave our initial trend line in place, and we draw in our new trend line, okay? Connecting the very low to this new low. Once we have that trend line in place, we can see that price actually breaks through that new trend line at this point here and trades down to forward yet another new low outside of our two original trend lines. So once that happens, we again update our trend lines by adding in a third trend line, again starting from the very low attached to this swing low. And you can see that this trend line was actually respected a little longer, okay? So we got our trend line in place here, having connected these two touches. Price then bounced up, traded back down, retested the trend line, held and bounced a further time. We didn't break that trend line up until this point here. So at the point that the trend line was broken here and we forged yet another new low outside of the trend line, we then go ahead and add in our fourth trend line, okay? So again, we start from the very low and attach that trend line to the new swing low here. So you can see now the process that we go through in terms of updating our trend lines, but also look what happens when we leave those old trend lines in place. You can see that they actually still retain relevance in the market and that price still respects them, but in a different way. So here, having broken through our first two trend lines, price trades back up and actually finds resistance at the underside of that broken initial trend line. Okay, we then trade down and find support at our second trend line. At this point, you can see that once again, we trade back up and find resistance at the retest of that broken initial bullish trend line. Here is another great example, 3 great examples here of price respecting that broken bullish trend line from the underside, okay? And the reason that price respects trend lines in this way is due to the shifting order flow dynamic that is present in the market and driving price action all the time. And we'll talk about that in greater detail in the support and resistance webinar, which we'll move on to in the next session. But for now, just to give you an idea of how it can be useful to leave these old trend lines in place and the way that the market continues to respect them even once they've been broken. So now that we know how to identify our trend lines, and now we know the type of way in which the market can respect these trend lines, we need to think about ways in which we can actually use trend lines to trade. And the first, it's the most common, it's the most basic way of using trend lines to trade, is simply to look to buy rising trend line support and look to sell descending trend line resistance. So here we have a nice clear example of a bullish trend line in place and a manner in which we could look to trade this trend line. So again, I only look to identify a trend line based on 2 swing points. So once I've identified these 2 swing points in place, I go ahead and connect my trend line. Once my trend line is in place, I'm then monitoring the market, looking for price to trade back down and retest the trend line to see if I get a potential trade setup. So imagining we're at this point in time here, we just connected these 2 points, we've got our trend line in place, price bounces nicely up, we break above these recent highs, we then start to fall and trade back down. So as price starts to trade lower like this, it is simply a case of monitoring my trend line and waiting to see if price trades back down, retests that line, and if it holds it, okay? And you can see here that price does in fact respect the trend line, and we get a really healthy bounce from here with a really good opportunity for profit. So again, as I say, I don't look to trade trend lines just purely because there is a trend line there. I'm always looking to identify confluence. So a situation where a trend line syncs up with good support and resistance, or where we get a Fibonacci level, and where we have specific price action signals. So you can see here in this example that the manner in which we could actually look to enter this trend line could be based on a price action signal. So you'll see that we trade down into the bullish trend line. This first bearish candle stalls. We then get something of a doji candle, which represents indecision in the market. And then secondly, finally rather, we get this bullish engulfing candle. So we get this really big burst of demand in the market, and price closes back above those 2 candles. So this would be a really good classic price action signal that we could use looking to get long based on the trend line. Again, for those of you who aren't familiar with candlestick reading and price action, that's another topic that we'll look at in this series of webinars. But for now, just to give you an idea of the way in which we can use trend lines, okay? Because I know that for all of you, you see trend lines on people's charts and maybe you aren't totally clear about how it is that we look to use them. And so this really is the most basic and simple way in which we can look to incorporate trend lines into our trading, is looking to use rising trend line support as an area to buy, and then the inverse would be looking to sell bearish trend line resistance, okay? So we've looked at how we can use the trend lines alone, okay, and think about the way in which we can enter based on price action signals. But moving on, just to look a little bit at how we might start to use trend lines in confluence with other areas of technical analysis, okay? Because as I mentioned, the trading that I do myself and that the other LFX traders do is all based around identifying confluence in the market. So we're always looking for synchronicity between different technical elements to strengthen our conviction in a certain trading idea and to highlight an opportunity in the market. So here we have a classic bearish trend structure, okay? You can see we've got a series of lower lows, lower highs, lower lows, lower highs, okay? So price is falling in that nice stair-step fashion that indicates a bearish trend. You can see we've also got our bearish trend line in place. Now, let's think about price being at this point in time here, okay? So we're bouncing up from these lows and we've got our bearish trend line in place. So we know that we're looking to monitor our bearish trend line to identify a possible trading opportunity. Now, as I said, I don't like to trade a trend line simply because there is a trend line there. I'm always looking for confluence with other technical factors. So in a situation like this, where I've got a bearish trend line in place and price is moving back towards it, I'm then looking to identify any other technical factors which suggest to me that price is likely to find resistance at that trend line and is likely to give me a trading opportunity. So looking at this chart, the first thing that stands out, okay, is this broken support level here. Okay, again, for those of you who aren't totally familiar with support and resistance, we'll be looking at that in the next session. But the first thing that stands out to me here is this broken level of support. So you can see we have these three big lows here. So there was obviously a lot of demand in the market to hold price up at this level. We then broke down through that key structural support. And so now I know that supply is stronger in the market at that point. And so as price is trading back up, I'm immediately thinking to myself that this looks to be a really great area that I could set shorts, okay? And so firstly, we've identified good confluence between our trend line resistance and our structural levels. So we can go ahead and mark in that broken support, okay? So you can see that broken support, which turns to resistance, or which we can anticipate is likely to act as resistance, we can see comes in nicely with that bearish trendline resistance. And so we have two factors there. We have a confluence of structural resistance and trendline resistance. Now at this stage, we can go ahead and look to identify a further element of confluence. And a classic tool that I always use in my trading, and that a lot of traders, okay, from private traders right through to people who trade for investment banks and institutions, a classic tool to use is Fibonacci, okay? A Fibonacci retracement of price swings within a trend structure can be a fantastic way to identify great entry opportunities. So if we go ahead and add in our Fibonacci retracement from this last swing high down to this low, and then we can look to identify if we have any confluence between our clear Fibonacci levels and our trend line. So you can see immediately that we get really great confluence with the 50% retracement of that Fibonacci swing lining up perfectly with this broken support level now turned to resistance, and we have the bearish trend line overhead. So this would be a classic example of the type of trade that I would take, or that we would issue on the site as an alert, okay? So where we identify really solid confluence between three technical factors such as this, then this would be a definite trade setup for me. And actually we can go one further, because if you look at the highlighted area here where price has actually traded up and tested that bearish trend line, you can see that we've also got a price action signal, okay? We've also got a bearish pin bar candlestick. Bearish pin bars are a classic reversal candlestick. So the presence of that pin bar at this level where I've identified such strong confluence would signal to me that I was right to get short in the market. And you can see from this setup, okay, this is a sterling Kiwi chart on the 60-minute. You can see that the fall from that level, 220 down to 215, is just shy of 500 pips. So I'm in a really fantastic opportunity, and hopefully you can see just how simple the process is. So if I showed you this chart initially with all these different elements in play, you might think that it was quite complicated, but going through in this methodical manner, you can really see just how simple a process it is to identify these levels. And this is the process that I follow day in, day out in the markets, and the sort of process that you really need to build into your own analysis and trading. So here is another example of pretty much exactly the same setup. Again, just to really hammer home to you the type of setups that you really should be focusing on. So once more, you can see we have this really clear support level that price broke down through. We traded back up, and the point at which we retested that broken support, we also had this really nice bearish trend line. And again, we have Fibonacci confluence with the 38.2% retracement at that level. And then once more, the cherry on the cake, we also have that bearish pin bar, so another price action signal. So we won't always get a price action signal in situations like this, but where we do get a price action signal at such a really solid area of confidence in the market, then this should really increase your expectation of success on a trade, because that is a really strong signal that we're likely to reverse. So hopefully you're beginning to understand the type of setups that you should really focus on. And one of the things that I always say to a lot of the new traders that I work with is that if they really just focused a lot of their energy and time on trading setups which come as close to perfect as possible, then they really would increase their success, and also stop a lot of the hassle and aggravation that a lot of new traders go through when trading, okay? So many traders force their analysis on the markets and get involved in subpar situations where they're having to really struggle to identify setups, and all that does is deteriorate their bottom line. So if you really focus just on identifying these really clear, really solid setups. Because the thing is, when you get great setups like this, they just jump off the chart at you, okay? So where you get this clear confluence between different technical factors, you really don't have to force or struggle or spend too much time deliberating about whether or not you do in fact have a setup, whether or not you should trade, because it just screams out at you, okay? You can see here that where these factors line up so perfectly, these are the type of situations that you want to be getting involved in. So we've looked at how we can trade trend lines in a basic manner using rising trend line support for a buy entry and using falling trend line resistance for a sell entry. We've also looked a little bit here at how we can start to use trend lines in confluence with other technical factors to identify high probability trade locations. So now we can move on and start to think about trend lines in a little more detail, and we can start to be a bit more strategic with them and think about other ways in which we can trade them. So another great way in which we can look to trade trend lines is trading the retest of broken trend lines. So we saw in that example of the dollar Swiss how when trend lines are left in play, once price has broken them, price still tends to respect them even when it's testing them from the other side. So once price breaks down through a rising trend line and trades back up, it tends to act as resistance, okay? So in this example, you can see we have our bullish trend line in play, acting as support, price breaks down through, trades back up, and then the trend line acts as resistance. And it's the same with a lot of bearish trend lines. You see price respecting the bearish trend line as resistance, it then breaks through to the top side, trades above it, only to trade back down and then retest the trend line and find the trend line acting as support. And again, this is due to the shifting underlying order flow dynamic that drives the market. But we can exploit this dynamic, okay? And this is another situation which I incorporate into my own study, my own analysis and trading on a daily and weekly basis, is looking to identify these breaks and retests of really clear trend lines, because these can be fantastic trading opportunities. So looking at this example here then, and you can see if we just skip back, this is pretty much a carbon copy of the beautiful image which I've drawn for you here, and it's represented very well in the charts. So you can see that we had this really solid bullish trend line in play in the dollar yen. Price was bouncing along, finding support at that level each time it touched it. So we know there's good demand in the market along this trend line. But then at this point here, look what happens. Price breaks down through that rising trend line, trades back up, retests the underside of the broken rising trend line, and now instead of that trend line acting as support, the trend line is acting as resistance and price trades lower. So this is a fantastic opportunity, and the great thing about using trend lines in this manner is that they can really help us to identify key turning points in the market, because essentially what we're seeing here is a potential change in trend. So once price has broken down through this bullish trend line, this alerts us to the fact that potentially the bullish trend is ending. Once price then trades back up, tests that bullish trend line, fails to get back above it, then this signals to us yet further confirmation that the bullish trend is ending and that the bearish trend is beginning. And then obviously we look to identify a bearish trend line that price respects to signal to us that there is in fact a bearish trend in play. But looking to identify these areas where price breaks down through these trend lines and then retest them can be a fantastic way to get in early on major market moves, big reversal points. So this is a really fantastic way that you can look to use trend lines, looking to identify the breaks and retests of these solid trend lines. So as well as just using trend lines in isolation, so in terms of just applying one trend line to the market, we can actually go ahead and apply two sets of trend lines to price, and this gives us channels. So with regular trend line analysis, in this picture, we would simply identify a bullish trend line, okay? We know that we look to connect at least 2 price points to give us our trend line. In a bullish series, we look to connect a series of rising swing lows, such as we have here. And so once we've got our bullish trend line in play, we can actually then go ahead and see if we do have a bullish channel. And the way that we identify channels and the way that we apply channels to the market is a very simple process. So we simply clone our primary trend line. So in this instance, we've got a bullish trend line. We simply clone that trend line and then move it to the top side of price, okay? We apply it to the first significant swing point, which would be this swing point here. And then we look to see if price respects that upper trend line. And if it does, we have a bullish channel in play. So if we go ahead and clone that line and apply it to the top side, so here we can see that price does in fact respect that upper trend line. And what these two trend lines actually represent now is rising trend line, bullish channel support rather, and bullish channel resistance, okay? So within this channel, this is the support level which price bounces from, and this is the resistance level which price reverses lower from. That's very key to point out here. And one of the interesting things about channels is that we can actually anticipate their formation. So obviously we identify our trend line once we've connected two price points, okay? So imagining we're at this point in time here where price is bouncing up and we can't see any of this price action to the right. All we would do is simply go ahead and clone this trend line and apply it to the first significant swing point. We would then look to monitor price as it trades up to retest that line, looking to see if it confirms it. So if price trades up, respects that trend line and reverses lower, then we know that we do in fact have a bullish channel in play. Obviously, if price just shot out above that trend line and broke higher, we wouldn't have a bullish channel. We would still have a bullish trend line. So we can look to anticipate the formation of channels. And then once we have our channel in play, there are two ways really in which we can use them. The first way is we can look to use them for trade management. So one of the major proponents of our trading, one of the major things that we focus on is we're always looking to trade with the trend. So for as much as possible, we're always looking to trade with the trend, as this is proven time and time again to be the most profitable way of trading in the long term. So in terms of trading with the trend, then we'd be looking to buy rising trend line support. And so we can use our rising our bullish channel resistance as a trade management location, because we know that price is likely to find resistance as it touches that level and fall backwards. So we can look to cover our positions there, either moving our stops to break even, taking some of our positions off, or indeed banking, using it as a target. Now, alternatively, we can actually initiate counter trend trades at this level. So as I say, we advocate for the most part trading with the trend, but there are certain instances when trading counter trend can be a profitable opportunity, a profitable proposition. So again, looking to identify confluence with different factors. So if we saw this bullish channel resistance syncing up with a key structural level, such as a double top and Fibonacci level, a key Fibonacci level, then that might be a location which we could look to test the market from in terms of a counter trend trade. So those are the two ways in which we can look to use channels. And the beauty is that they give us further color on price movement. So if price is just respecting a bullish trend line, we only really have information on one side of the market. But if price is respecting a clear trend line along the other side, then we also have this channel formation. And this gives us another area which we can look to monitor and another area of interest in which we might see potential trades develop. And obviously the same instance is true. Once price breaks above this bullish channel resistance line and tests it from above, it's likely to act as support. So again, the process you need to follow is always monitoring your charts and updating them with the most relevant trend lines which consider the most recent price action. And once you start to do this and you become quite competent and confident in doing it, what you'll tend to spot, and this is the type of thing you should be noting down in your trade journals, is the way in which price continues to respect these trend lines even once they've been broken, okay? So long as you've identified a valid trend line or a valid channel in the first instance, then you'll notice that once price eventually breaks them, it does continue to respect it even when it's testing it from the other side. So channels, another fantastic way in which we can apply trendline analysis to the market and identify trading opportunities. And the final thing we're going to take a look at is how we can look to combine trend lines and channels together. So we can look to use trend lines and channels to perform our analysis and to identify trading opportunities. Okay, so here we have a clear example of a bearish channel with a counter trend rising trend line. And so let me talk you through what we're seeing here and what the trade setup is. So this is another really great setup which I focus a lot on, which I'm always looking at the markets for. So what I like to identify is a broad trend in the first instance. So here we can see that we have a broad bearish trend. Okay, this is our dominant trend. Price is falling low with a series of lower lows, lower highs, lower lows, lower highs. So we go ahead initially and connect our first two price points to give us our trend line. So we've got our bearish trend line in play here, and we can actually go ahead and add in our trend line to the underside of price and see that we have this really clear bearish channel. So once I've identified price moving lower within this clear bearish channel, I'm then looking to identify short-term periods of correction against the trend where price is moving higher, and then I'm looking for the exhaustion point of that correction. So the point at which the upward move fails and price starts to turn lower again. Okay, so the momentum is to the downside here, the big opportunity is to the downside, and the way that we look to capitalize on a bearish market is by identifying these periods where minor corrections fail and the dominant trend resumes. And so you can see at this instance here that we get a really interesting development. Okay, price has been falling lower in this really clear stair-step fashion, and at this location here you can see that the correction actually takes on a really interesting form. So this series of rising lows, we can actually go ahead and identify a bullish trend line, which we class as our counter trend bullish trend line. Okay, so we've got a bullish trend line within a broad bearish channel, so this is clearly a counter trend move. And then simply all we're looking to identify is a break of that trend line, which signals a failure of the correction and a resumption of the broad dominant bearish trend rather. So depending on how you trade, you can look to simply trade the break of the trend line, or you can look to trade the retest as we discussed just previously. So if we zoom in on that example here, first of all, you can see we have our clear bullish trend line in play here, connecting these rising swing lows. We then break down through that rising trend line, trade back up, retest the underside of the broken trend line, and remember this is the point that really signals the failure. Okay, so the break of the trend line alerts us to the fact that the bullish period has finished, but it's the retest and the failure to get back above that bullish trend line which really signals that the market has changed sentiment. And then the area in which I would typically look to trade this is actually a break of this low. Okay, so I don't for the most part trade breaks of trend lines. Okay, I do some breakout trading where I trade breaks of structural support and resistance, and we'll look at that in our next session. But for the most part, I don't trade the breaks of trend lines just because I find them a little bit treacherous, especially on the lower time frames. We can often get a lot of false breaks where the market tests beyond the trend line only to reverse and go back inside it. So the way in which I do look to trade broken trend lines is by identifying a failed retest such as we have here and then playing the continuation. So the way in which I would trade this is look to identify an initial low here, which becomes the support, a retest of the broken trend line and a failure, and then I wait for price to break back down below this initial low. So it's kind of like a slingshot move if you think about it. Price has broken down through the trend line, the slingshot has pulled back, we've retested the trend line, failed, and then it's let go here and catapult back down rather. So this is the way in which I would look to trade these. Again, it depends on the type of trader you are. Some traders are happy just to trade the break of a trend line. Some traders trade the retest of the trend line here. But in these instances, I really like to wait for that final bit of confirmation, which is the break of that initial low. So hopefully you've got a clear example now of how you can incorporate trend lines and channels into your trading. So that's been a good first session. We've covered a lot there in a relatively short amount of time, and I hope that you found those examples clear and that you found them useful. So Amar Muller asked, do you prefer connecting wicks to draw trend lines or bodies? So that's a good question. That's one I get a lot from a lot of new traders. Generally, I find that where I can connect the wicks of candles, they're just as powerful as they are if I can connect the bodies of candles. So once you move on to slightly more advanced trendline analysis, you might find that in some instances you're connecting wicks, in some instances you're connecting bodies. Really, it comes down to getting a feel for where the real trend line should be. So there will be some instances where I'll be drawing a trend line that actually dissects price action a little bit and cuts out the wicks of the candles and just connects the bodies. But again, as I say, when you're first drawing trend lines, look to just connect the wicks, so the very highs and the very lows, to give you the absolute trend lines. And then once you've spent some time applying your trend line analysis and you've built your confidence, then you can look to alter it slightly and be a bit use a bit more discretion with your trend lines. So I hope that answers your question. Before we wrap it up, guys, are there any more questions that I can answer for anyone? Great, okay. Well, I'm pleased that you found that all clear and useful, and I look forward to catching you all next time for our next session. In the meantime, please feel free to head to the website www.littlefishfx.com. You can check out all of the great education material we have there, as well as the daily Forex reports and the master course and the indicators we have. And as a thank you for attending the session, you'll see there's a coupon code here for a discount on the various website products. So thanks a lot, everyone. Good luck with your trading, and I'll catch you all next time.
Yeah, thank you, James. It was a really insightful presentation. I hope every one of you enjoyed the webinar. So if you like the concepts introduced in this webinar, you can head over to learn.tradimo.com and check out LittleFish FX's courses, the NFP trading course, and also the FX top FX strategies, trend lines, Fibonacci price action, and more. And when you enroll for the top 4 strategies course, you get 1 month access of free analysis and live trade alerts. And as James mentioned, you also get 20% discount on all LittleFish FX products if you use the LFX Tradimo coupon code at their checkout. So thank you again for coming. For the next session, please watch our announcements, and see you again in a few weeks' time.